Some technical issues, so I apologize for that. But I think we're just going to begin. So, hello, everyone, and welcome. And thank you very much for taking the time out of your busy day and joining us at our fireside chat. My name is Ann Chu, and I head the global product team here at Suisse. And so, our discussion today will focus on the recent bank collapse at SVB and Secure Bank and Credit Suisse. And once again, this type highlights the importance of regulatory oversight of banks and the potential consequences of the failures. It's crucial to ask the right type of questions and engage in open and honest conversations from industry leaders who face this type of risk every day and how they're navigating and leading their organizations through these type of uncertain times. So that's why I'm so excited to have an opportunity to sit down and have a chat with the Chief Risk Officer and an advisor, a tech advisor at Allstate, Jason Wang, who brings with him a wealth of experience in the risk management space. He has an MBA from Stern School of Business at NYU and a CFA charter holder. Jason has held a diverse and prominent roles across the financial service industry before taking on leadership roles at Allstate and Synergy and Progressa. He's worked in equity research and risk management at some of the largest and well-known and respected firms in the industry, like Citi and CIBC. So I'm very eager, as I'm sure most of you are, to hear Jason's insights and perspectives on the recent bank collapse and the overall concerns regarding the regulatory oversight of banks and how to prevent these type of things in the future. So welcome, Jason.
Hi, happy Friday, everyone. Good morning, good afternoon, good evening, wherever you are. I'm really happy to be here. Maybe just a disclaimer, the views expressed here are solely my opinion and they don't represent the views of my current or previous employer.
Great. Thanks again, Jason. And just hope you don't mind. I'm just going to jump into questions. So, like, obviously, there's been recently a whole bunch of commentary and surrounding the recent bank failures and lot of anticipation with the Fed's overall review on SVB that is set to be released sometime in May 1st. This report is expected to shed some light on the underlying causes and details of the events, and organizations are embracing for the increased scrutiny on the regulatory on upcoming regulatory changes. So, as a chief risk officer at your organization, what type of risk management and reporting areas do you believe that you should try to prioritize before receiving any sort of guidance provided by regulators? And additionally, what kind of lessons do you think you've learned that needs to be improved in organizations in general to be able to detect and monitor these type of potential issues?
Short answer is if you run a bank, if you run the risk management department, look into your capital stress testing, look into your liquidity management, look into your asset liability management. I think that's the one sentence answer to what do you need to do now. We know that the failure of Silicon Valley Bank is such a complicated story. There are many moving parts, many factors. Also, downstream, there's a lot of impact to the stakeholders involved. And people are going to write books, make movies, maybe about this, and it's going to become a classical case study in business schools. But we have only 30 minutes. So the focus here is what are the best practices? Maybe I would say not even best practices, but minimum requirements if you run a bank for risk management. I think traditionally, some of the banks have been comfortable where if you are an investment bank, you focus on investment risk. If you are a consumer-facing commercial bank, then you typically focus more on the lending risk or the credit risk. But there are more to that. I would say there's typically 6 types of risks, and of course credit, but there's the interest rate risk, or sometimes it's called market risk, and then there's liquidity risk, there's strategic risk, there's operational risk, and then there's legal, regulatory, and reputational risk. Some banks have traditionally been too biased when it comes to credit. And in the case of Silicon Valley Bank, they actually did a pretty good job when it comes to selecting who they wanted to invest money in. And I think they got some really promising candidates. And that's not actually what brought them down.
Mm.
So I think as a risk manager, you should not just focus on who are we lending our money to. You should focus on all of these different things: capital, liquidity, your strategic risk, your legal, regulatory, reputational risk. All of these matter.
Is it because it's easier to measure, like a credit risk? There's a formula that's involved. You can do the calculations, but those type of risks that you're talking about is a little bit more difficult to kind of manage and being able to recognize. Do you think that's the reason why there's so much focus on like credit risks, like you say, as opposed to something like rent to a bank? You have no idea when that's going to happen.
Uh, Interest rate risk or liquidity risk, asset liability management are surprisingly easier than a lot of people think to measure too. You can measure them. I think it's probably because when we talk about lending, it has it shows up on your P&L, because if you have this much for your loan loss reserve, it does impact your P&L. So people tend to focus more on those. And when we talk enterprise risk management, it sounds less fancy, less
Mm.
sexy. It doesn't use a lot
Mm.
of data science tools. So
Right.
these people tend to be seen as, oh, it's a little administrative and it's a boring job. They don't carry as big a voice as the credit people do. So
Right.
that's what I meant by the bias. But you can
Right.
measure this. So
Right.
I'll give you an example of how, for example, you can measure your interest rate or your asset. I'll begin with asset liability. There's a term that's called static gap, which is really simple. At any given point in time, the gap in between your asset and your liability. You need to manage it and have it within a very small range. Otherwise, you
Mm.
have an issue. And we know that in the case of Silicon Valley Bank, people were lining up to try and get money
Right.
out, but their investments are tied. A big majority of it is tied into low rate bonds that's actually held to maturity. So they can't get that out to pay these depositors. So you have to watch that very closely so that you make sure that you can have that much cash available to pay your depositors if they do decide to get the money out. And some measures I've used in my past career to measure the interest rate risk would be a simulation that's called a shock up and shock down simulation. So that means if we think that central bank will have a shock interest rate increase of either 100 basis points up or 100 basis points down, that means that our economic value will be changed by this. And look at what are the most important metrics you want to use on the bank safety. Then you can basically simulate that with shock
Mm.
up and shock down. In a very low rate or stable rate environment, sometimes people question, why do we even need to do these simulation? I think I had
Right.
these questions asked before last year. So because rate has been low for a long time, but then as we all know, rates
Right.
went up quite a
Right.
lot by more than 400 basis points. So this is where 100 basis points shock analysis seemed quite necessary.
There's a fun type of things where it's something that's useful, but it's not being done because it's not required per se by a regulator. Saying the regulator kind of saying you have to do these type of tests, you have to be able to do it regularly, you have to be able to submit it, and because it's not required, maybe people do not feel this is necessary or required. So you just have to make sure that's one of the requirements maybe going forward. So I just want to return back just a little bit to the topic of regulatory changes. So we know for sure there's going to be some changes coming our way in the horizons, and there's talks about increasing reporting frequency, like I said, from maybe monthly to daily, and possibly rolling back the capital and liquidity requirements to the pre-2018 levels. which probably means like the banks between 100 billion to 250 billion would once again be required to conduct the stress testing they were talking about. So, like in your opinion, what other things do you think that you foresee or believe should be implemented, or you think that will be required for financial institutions going forward?
So, as of now, the capital stress testing requirement is basically an annual requirement reported up to the regulators.
Mm-hmm.
Then it's a question within the organization whether there's governance around more regular, more frequent stress testing. And a lot of people, again, see this as just necess- uh, necessary evil or administrative work. So we're going to do what they ask us to do, which is
Mm,
annual stress testing. But I think maybe it makes sense for the board to ask for a more frequent stress testing analysis. I don't want to spell out to say, well, whether it should be quarterly or even more frequent than that, because it is work. It does add to people's workload, but this is important work. So I think the regulators need, not only do they need to receive the report, of course, they need to be satisfied that there's some type of governance, maybe from the organization's board, risk committee, so that they know that these things are being looked at on a more frequent basis
mm,
within the organization. And the board needs to have people who understand these measures to ask the right questions. So I think that's an area where the regulators may need to spell out how they want to be satisfied. They don't need to necessarily get quarterly reports because that's a lot, but they
mm.
need to be satisfied somehow that this is being done. I think I sound like I'm asking the regulators to be a little more hands-on, but in tough times, we appreciate how the hands-on approach
Right,
could actually prevent the banks from hurting themselves.
right.
So maybe the regulators also need to be a little more specific in spelling out some specific measures of asset liability management, liquidity management, interest rate management. Measures that I mentioned earlier today: shock up analysis, shock down analysis, right? So, of course, we are talking about how shock up is bad, and that's what it really just caused the collapse of a few banks. But a shock down could equally be bad, and this probably will be a topic for a different day. So, a shock of either direction of 100 basis points, what would that mean? And I can give you a consumer mortgage example in the Canadian consumer mortgage
Mm,
market. In very low rate environments, this started a few years back. Basically, the government rolled out this rule that said anyone, because it was very cheap to borrow back then. Interest
right.
rates were practically very
Yeah.
low, almost
Right.
zero, so
Yeah.
you can get free money. So the regulators in Canada have been known to be conservative, and actually, I want to thank them for being conservative. So they rolled out the rule that says any consumer who's looking to be qualified for mortgage, we know that you need to run their credit and look at their income and their debt obligations and run the debt service ratio on them, but run a hypothetical interest rate that's 200 basis points than the current market rate. Run that number on them, stress test them to see if they can actually still afford the mortgage at that rate. So if consumers go through this, banks, there's no reason the banks don't go through this, right?
Right.
So because
Right.
I think the stakes are so much larger. If any particular bank fails, it's much, much, much bigger than any one particular consumer mortgage that goes bad. So that's an example of how I think conservative some of the banks should be when it comes to stress testing.
That's a good point, and this is a good point. Sometimes maybe there's a lot of pushback. Of course, regulations are bad because let's put a lot of onus on uh, on organizations to busy work. But sometimes, like you said, it's a required necessity that's actually protecting the organization from themselves. And then also, it's also useful for providing them guidance, like they might not know exactly what to start. So having regulatory guidance on the type of stress testing that should be incorporated into their risk management practices would be helpful. Like you said, some of the scenarios that you've mentioned. But it's also interesting that you're mentioning Canada as well too. So you're in Canada, and I'm actually interested in your perspective. That was a great example where you brought up about the mortgages. So what are the differences? Other differences you think in the regulations in Canada that you think it's also helped protect the Canadian banks from running into this type of scenarios, and that we in the U.S. might consider also incorporating or considering as best practices to help manage this liquidity and financial risk?
So I mentioned earlier that the Canadian regulators tend to be conservative, and it's just not it's not only the regulators. That's basically the Canadian mindset that we are a little more conservative, and maybe for a good reason in the banking world. In the 2008-2009 global financial crisis, I can tell you that not a single Canadian bank failed for capital reasons. And we know that hundreds of banks in America failed because of capital reasons. Not a single Canadian bank failed for capital reasons. Canadian banks have failed for other reasons, but not capital reasons. So that's just simply because the capital reserve ratio that the Canadian regulators ask for is pretty tight. So, and then sometimes if you are not a federally regulated financial institution, so I worked at a provincially regulated financial institution, then the provincial regulator actually adds a couple percentage point onto what the federal government wants. So, and the board asks another buffer. So we have buffer plus buffer plus buffer. When it gets to us, then we need to make sure that we really have that very, very high capital reserves. And sometimes you think, okay, so that's a lot of capital that's tied up, not making returns on this money.
Yeah.
But then in tough times, you realize that that's the money that can actually save the bank, right? So the pushback is pretty common because this is a lot of work, I was on the receiving end of a lot of regulatory requirements when the regulators say not negotiable, you guys have to do this. I would say where the regulators should probably have some level of understanding would be right size regulations, or for smaller institutions, come up with a way to manage your expectations to be a little lower on these, because there are even credit unions in Canada that have less than 10 employees. So you can't expect them to do the same amount of regulatory reporting or measurement that a major bank or a global bank with hundreds of thousands of employees, right? So this is where I think for smaller institutions, the understanding should be there. Also, if the smaller institutions do fail, the impact is much, much smaller. Now, we know in the case of Silicon Valley Bank, they were the 16th, or some people say the 17th largest bank. So the impact is there. I think for big banks, there's no excuse. They aren't a bank that's 160 years history. They were set up a couple of decades ago to invest in tech companies. So I think maybe they were running and growing really fast, where they did not realize that they should put the same amount of energy and investment into growing these risk functions. And we know as a fact that they run for 8 months without a chief risk officer. Of course, their board jumped in to help out, but it's not the same. You do have that independent second line of defense to tell the first line of defense and the big boss that some things are not right.
And I think also they did have to do that regulatory requirement. They passed that threshold, and so previously I think they didn't necessarily need to do those stress testing reports, but they passed the threshold. We had, I think for the U.S. there's like huge time zone, or kind of like a time where they can prepare for the regulatory reports to be done. So during that time, they didn't, even though they needed to do it, they didn't. There were they didn't need to report it yet. And I think during that time, when they passed the threshold and they grew in size, not doing that regulatory reporting and the stress testing, he said, actually hurt them. Where they could have caught those issues and being able to manage it, and because they didn't have to do it at a timely basis, it affected and possibly contributed to their downfall. So just continuing the line of conversation on the amount of work required for to prepare for these reports. How, I guess the question is, like, do you think like the systems and is equipped and ready to handle the type of changes that might be coming and down the road? Like I said, they might increase it to, instead of monthly, from quarterly to monthly, so from monthly to daily to some organizations, and then maybe pushing down the threshold for liquidity requirements of reporting for maybe organizations that didn't have to do reporting anymore to now having to reporting. Like, how much work do you think that's involved within a financial institution, and how much heavy lifting is involved to be able to do that?
So it's a great question. A big reason why a lot of banks and even risk management people want to push back on this work is because it's a lot of work. So I want to be clear when they say it's a lot of work. It's probably related to how much manual effort it still requires to do certain things, because typically this hasn't been an area where the management, the leadership wants to invest a lot of dollars in. There are tools that exist today that help you streamline the work and automate part of the work. Or if you can deploy a couple of data scientists on this, run a model, run a program, you could make this done, make this work, get this work done in a very timely manner. But again, because this doesn't show up on your P&L, so this is where the bank wants to maybe deploy their resources in an area where there's perceived higher ROI, because a lot of people don't see the ROI here to invest in a tool. So people are still using manual Excel spreadsheets to do the stress testing, and they are still using some emails back and forth to talk about gathering information. Sending you a dashboard. A lot of this could be automated. I don't want to mention the names of any tools, but there are a lot of these out there, and they do cost money. But this is where I think that tough conversation needs to be had with management to talk about this. And I think maybe the focus isn't ROI. We're not trying to make money off of this tool. Or you could look at it this way, the amount of manual work that you save, you can translate that to FTE, and you can translate that to ROI. But in a way, if this helps with reducing and minimizing and mitigating your regulatory and your capital risk, then I would say go for it.
Yeah, you can view it as a cost, or you can view it as an investment and actually potentially a way to actually potentially grow your business. Because it takes a lot of data and effort to be able to properly analyze the data. And so once the data is in the system, there's just lots of use that you could potentially use. If you look at it at an enterprise level, you could then do like what if scenarios, like stress testing, but what if scenarios, like what if I enter, and now it's in the system, why not? What will happen if I enter this line of business? How would that affect my capital? How would it affect my liquidity? So there's a lot of things that you can actually use it for beyond just regulatory reporting, if you think about it strategically and how it can be incorporated as an enterprise. And it goes back to the cost, right? So you're viewing it as right now only hire 1 or 2 people to being able to do the regulatory reporting. But if you invest in a proper system, that FTE can then be freed up to do that level of analysis and being able to then be able to do I guess, work that could potentially bring more business into the firm. So again, it's all how you view it and how you strategically invest in your systems to be able to produce the proper systems for your organization. So I'm very conscious of time. We have a couple of minutes left. So Jason, any closing remarks you want to say before we close?
So, I probably will say to whoever is the CFO or the CEO out there, the mindset shift starts with you. You hold the voice, you hold the tone for the whole organization. That enterprise risk management is important, and the CFOs hold the checkbooks. So this is where you need to invest your money, invest your resources, hire more people for the team, look into some better tools. This tone has to be set at the very top, and it can't be a grassroots movement. It can't be a few risk management analysts who are voicing their opinions, and then they feel like they don't get heard, and then they get disgruntled, and then they start to do quiet quitting. This seems to be a new trend out there. So
Just
it's
use the
your
words.
responsibility. If you're the leader of this organization, it's your responsibility to set the tone right, to give your risk management people the stature and the proper investment so that they can make sure that the whole bank is safe.
Wonderful. Thank you, Jason. Jason, I just want to thank you again for sharing your insights and expertise with us during this fireside chat, and your thoughtful analysis has given us like so much to consider as we move forward. So we really appreciate your candor and willingness to engage with us and the broader financial community. So thank you again for your time and valuable contributions. And of
It's
course,
my
I'd like
pleasure.
to
Thank you.
thank you, and I'd also like to thank everyone else who joined our call today. If you have any comments or questions or follow-ups, or you can always reach out to me through LinkedIn, or you can also visit our website below and get more details on all those regulatory changes and how to help you with those. So again, goodbye and thank you and enjoy the rest of your day.